The 2025 bull market continues and the S&P 500 just hit another new all-time high, but despite this, we have two dividend stocks with relatively large starting dividend yields sitting at a 52-week low, and today I want to review both of them, so let's go ahead and dive in. Now, starting off, we have United Parcel Service, UPS, a company we probably all know and likely have used before, and in the last year, it's now down around 30%, and look at this 5-year chart. Down around 44.64%. Now, the good news, I guess, about the sell-off, at least if you're not a shareholder, is if we look at the starting dividend yield for UPS, it's currently sitting at about 7.42%. Now, to put that in perspective, if we look at the historical dividend yield for UPS, it's climbed higher and higher due to this sell-off. In 2021, 2022, that yield was sitting only around 2%. Now, when we see an increase in dividend yield like this, it can be due to two reasons. One, it could be due to the sell-off, or it could be due to rapid dividend growth. So how much has the stock actually been growing its dividend? Well, if we look at it on a 10 and 5 year basis, at first glance, it actually looks like they've been growing the dividend at a very high rate, but this is why it's important to actually dig into the details a little bit more. We can see from 2014 to 2021, yes, there was decent dividend growth, but we saw a huge dividend hike from 2021 to 2022, but over the last few years, the dividend growth has actually been very, very slow, and it's pretty easy to see why that's the case. Look at the free cash flow payout ratio right here in 2023. It was over 100%. Now, again, remember, dividends are paid out of free cash flow. So a free cash flow payout ratio of over 100% is not sustainable. We can see in the following year, it was lowered to around 87%, but that's still the vast majority of the company's free cash flow. Remember, they have 5 options. They can reinvest back into the business, they can pay down debt, do mergers and acquisitions, buy back shares, or pay out dividends. So if a company is using 87% of their free cash flow to pay out dividends, that doesn't leave a lot of capital left over to do those other 4 things that I've mentioned. Now, look at the trends in free cash flow for this stock over the last few years. 2021 was a record-breaking year, over $10 billion in free cash flow. 2022, another great year at about 9.3. So we've seen a pretty large pullback in the last couple of years. It's only been about half of what it was the previous 2 years. So there's a clear reason, number one, as to why we've seen this stock sell off. But it doesn't just end there. UPS released their latest quarter's earnings about a half a month ago, and they pulled their full-year guidance due to macro uncertainty. Why is this not good news? Well, let's think about what's important to us as investors. If we look at the earnings presentation, you can see right here, 2025 guidance, UPS is not providing any forward-looking revenue or operating profit guidance. What does that mean to us as investors? Well, as investors, we're looking at everything from a risk to reward perspective. We want to get as much reward as possible while taking on as little risk as possible. And what that means is we want to buy companies that have predictable outcomes. And to get predictable outcomes, you need predictable cash flows. So when we have a company telling us they're not going to provide guidance as to what their revenue or operating profit will look like over the next year or so, that's a pretty big turnoff. In fact, technically speaking, if a company could tell me with 100% confidence exactly what their revenue, what their free cash flow would be, and how fast they'd be growing in the future, I could tell you the exact price I'd be willing to pay for it based on different financial valuation models. So essentially what this means is it makes modeling out the price that I would want to pay for it very difficult. So obviously this is not a good sign, and it's certainly part of the reason that we're seeing the sell-off of this stock right now. But then we have the third reason for the sell-off. We can see second quarter average daily volume declined by 7.3%. 7.3% year over year. That's a pretty big decline in volume. Now, there actually is a positive to this. If we scroll down and look at the next slide, we can see revenue per piece year over year actually increased by about 5.5%, which was able to help offset some of that volume decrease. So really, we can see each of these charted out here on Seeking Alpha, link in the description. But here's the average daily package volume, and here's the average revenue per piece. So we now have 2 quarters in a row where the average daily package volume has actually been declining, and this most recent quarter was a pretty large decline at 5.7%. But again, on the bright side, it looks like the revenue per piece has continued to increase for 3 consecutive quarters now. So yes, this is a good sign, but if this trend continues, it's going to be difficult for it to offset it over the long term. Now, if we go ahead and jump over to our profitability sheet and look at UPS, let's go ahead and zoom out, and I'll plug in the stock ticker up here. But first, I'd like to say thank you to Moomoo for sponsoring this video. Moomoo is your one-stop global trading platform with over 37,000 listed companies worth of financial data and over 26 million global users, And Moomoo does offer $0 commissions on stocks, ETFs, options trades, but as you probably know, Moomoo is a lot more than just a broker. For example, if we open up the app, we can easily build our own watch list. We can analyze the crypto market, stocks, options, ETF, and even get an overview of how the world is trading as a whole. But perhaps one of my favorite features of Moomoo, and probably one of the most humorous ones as well, is you can easily track super investors' portfolios, see what they're buying and selling, and you can even track some members of Congress like Nancy Pelosi and see what's in her portfolio and see how it's performing. And they make it very easy to see the key earnings reports that are coming up over the next few days and weeks. Now, for a limited time, Moomoo is actually offering an 8.1% APY for the first 3 months on your uninvested cash, and you can also get a chance to get up to $1,000 in Nvidia stock with a qualifying deposit. You can check out Moomoo at the link in the description to claim your bonus and see all the other great features that Moomoo has to offer. And here's one of the important things we need to make note of. Yes, if we look at that 10-year revenue CAGR, the 5-year revenue CAGR, both above 4%, but not only has revenue been declining over the last few years, on top of this, there's been increased cost. Look at the gross profit ratio. The 10-year average is about 20.45%, but last year's was only 18.77%. A declining gross profit ratio is almost never a good sign. And this is where UPS is focusing a lot of their efforts right now, and this is something they pointed out. They outlined a $3.5 billion cost reduction and network pivot while expanding healthcare logistics. And this is the unfortunate reality that UPS is facing right now. If you're seeing volume declines, and if you're simultaneously seeing a decline in the gross profit ratio, it's time to address costs. That's typically the easiest way to start cleaning up your margins a little bit. And I want to be clear, this is by no means a high margin business. If we jump over to the free cash flow analysis sheet, here's what I really want to point out. If we zoom in over here and look at the data, just look at the hard data, free cash flow margin, what is this telling us? Well, it's in reality probably one of the most important profitability metrics. It tells us for every $100 in revenue the company generates, how much actually becomes free cash flow. And yes, there's certainly some fluctuation that we've seen over the years, like in 2021, 2022, when the company had record profits. We can see the free cash flow margin was around 9 or 11%. But historically speaking, it's only typically sitting at about 5%. So for every $100 the company generates in revenue, only around $5 actually becomes free cash flow. So for example, free cash flow in 2024, about $6.2 billion, but if you look at revenue in 2024, it was about $90.9 billion. Not a lot of revenue gets translated to free cash flow. Okay, so I know so far it sounds like I've been very critical of the business, but it is clear they are facing some headwinds. There's a clear reason for the sell-off, but one of the things that I think is interesting is analysts actually seem to be quite a bit more bullish on this company than I would personally expect. To start, if we head over to Tipranks, they have a 12-month price target. Now, to be completely clear, I'm not a huge fan of one-year price targets, but I do think it's interesting that the average analyst is giving them about 20% upside. Let's look at them from a PE sensitivity model valuation perspective. Come up here, I've already plugged in UPS, and something that's interesting and really one of the cool features of ticker data is you can automatically import into your spreadsheet the average EPS estimate from analysts. Now, again, you can download any of these spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet over on tickerdata.com, link in the description. But what we can see when it comes to EPS projections for UPS, they're expecting negative decline in earnings in 2025. Now again, this is a little bit of what I would call a guesstimate because like we saw earlier, management team pulled their guidance. They're not giving us 2025 guidance. So again, this is more of a guesstimate. But it's interesting that after that, analysts are projecting double-digit earnings growth by 2029. They're projecting EPS on average will be about $10.42. To put that into perspective, if we jump over to our stock screener and look at earnings, we can see in 2024, it was sitting at about $6.76. So they're projecting that earnings will grow by about $4 per share. So with that in mind, let's assume that over the next few years, earnings grow exactly as fast as analysts believe at about 12.1%. Now we need to apply our future PE ratio. Now, the average PE ratio over the last decade for UPS looks a little bit high at first glance, but that's because we have some clear outliers like in 2020, for example. If we remove 2020, the average PE ratio drops to about 19.49. For the trailing 12 months, it's sitting about 13.03, which is 33% lower than the decade average. Now, I have to be honest, I do think that a PE ratio of 19.5. Now, to be honest, I personally don't see UPS with a PE ratio of above 20 anytime soon. And yes, there are headwinds over the next year, but if they are able to start growing earnings at a rate that's double digits like analysts are expecting, then we should see some multiple expansion. Just as an example, if the PE ratio gets to around 16, all of a sudden I have to admit we are looking at pretty attractive returns by the year 2030, a total return of about 112%, and that doesn't even include that starting dividend yield of about 7.5% you'd be getting every single year, potentially combined with a little bit of dividend growth. That'd be a compounded return of about 13.3%. Now again, to be clear, this is not what I'm saying will happen, but it is interesting if you use that average earnings expectation from analysts and just apply a somewhat realistic PE ratio. The returns do look attractive, I must admit. Now, if we jump over to our stock valuation sheet and look at UPS, there's really two valuation models that I want to pay attention to. The first is that historical multiple valuation, and we touched on this just a little bit in that other valuation, but if we remove the outlier with 2020, we can see that the trailing 12 months PE ratio is significantly lower than it has been over the past decade, like I just pointed out. That is interesting. And then if we look at the dividend discount model, again, we're valuing the stock based on how much they're paying out in dividends and how much that dividend will grow in the future. Now, assuming UPS can grow their dividend at a rate of about 3%, which you certainly would think is possible if they get anywhere close to growing earnings as fast as analysts are saying, then the stock would be worth about $122 per share, meaning it'd have 39% upside. So to me, it seems like there's a huge disconnect between what analysts are projecting with earnings versus what's actually going on internally with the business right now. UPS has pulled their guidance. They're seeing declining volumes for now 2 consecutive quarters in a row, and they're in the middle of a huge cost reduction. Perhaps there is opportunity with UPS, but like I mentioned earlier, I'm all about a risk-reward perspective. I want to make investing easy. I want to make my returns predictable. And because of that, UPS probably isn't a stock I'd invest in. And now we come to Lockheed Martin. Lockheed Martin is down over 20% in the last year to date, now down around 9%. But what's interesting is we can actually see they got a little bit of a boost on the day, and that's because they actually have a lot of business lined up. It's one of the more attractive things about this business. Lockheed Martin awarded a $720 million U.S. contract. Lockheed Martin, Switzerland sticks with F-35 purchase despite tariff-driven cost uncertainty. Poland strikes $3.8 billion deal to modernize F-16 fleet as defense spending rises. And then we have President Trump plan to build a Golden Dome. The business for Lockheed Martin is literally lining up for years. And this is one of the things that's typically outlined in their earnings report. We'll touch on this more in a moment, but here's what I want to show you. Backlog of $166.53 billion. That's how much business they have lined up for the future. So when we talked about UPS, we talked about the lack of predictability of their cash flows. The exact opposite is true with Lockheed Martin. They have business lined up for years. But with that being said, there is a reason for the sell-off. Now, to start off, we can see in their recent earnings report just a few weeks ago, they did beat on earnings by about 82 cents, but then they saw a miss on revenue. Revenue missed by about $380 million. But if we dig into it a little bit more, there's more to it. Lockheed Martin sank after surprise program losses / Q2 earnings. The decline was driven by significant write-downs tied to troubled aerospace and helicopter programs, and the market wasn't too happy about this. Now, what's interesting about this is if we look at their earnings presentation, they're still reaffirming their guidance when it comes to sales and free cash flow. However, they did update their guidance for segment profit and earnings per share. Now, if we look at Lockheed Martin from a dividend perspective, we can see that starting dividend yield sitting around 3%, and they've historically grown the dividend at about 8% or 6%. But just looking at Lockheed Martin's dividend yield definitely doesn't paint the whole picture of how they reward their shareholders. This company buys back a lot of shares. So look at them from a shareholder yield perspective. We can do this pretty easily using Bogle's valuation from tickerdata.com. Come up here and plug in Lockheed Martin. And here's what we need to zoom in and take a closer look at. Look at the weighted average shares outstanding here. In the last few years, they've bought back a significant amount of shares. 2022, 4.6%. 2023, bought back over 5% of their outstanding shares. And in 2024, around 4 to 5%. That is a lot of share buybacks. And remember, anytime a company is lowering the amount of shares outstanding, it's going to boost all the other per share metrics like earnings per share, revenue per share, and it even makes it easier to increase the dividend payouts on a per share basis. So if we just simply took the average buyback yield over the last few years of 3.3%, that would give them a shareholder yield of 6.25%. So that's capital that's being directly used to reward you as a shareholder. If we go ahead and jump over to our stock screener, I plugged in Lockheed Martin. You can see revenue per share, pretty stable, growing every single year, but not necessarily at a high rate. Earnings per share, there's a little more fluctuation, but again, the company is constantly buying back shares, and something you probably wouldn't expect is return on invested capital for this company is actually pretty impressive. They're typically in the range of about 15 to 20%. That's quite a bit higher than I would have expected it to be for this company. If we jump over to the profitability sheet and look at Lockheed Martin, here's something the company definitely doesn't want to happen again. There was a huge decline in the gross profit ratio over the last year, going from 12.5% all the way down to about 9.75%. Now, let's take a moment and talk about the valuation again. Now, I do think it's interesting. Look at Tipranks' average analyst estimate, currently giving them about 7.5% upside from their current prices. But let's put that into perspective. We'll go ahead and start just by looking at earnings expectations for this stock. Earnings, like we've already seen, really aren't projected to grow at a very high rate over the next year. But after that, analysts are projecting that they take a pretty nice bump up. Look at what Seeking Alpha is telling us for earnings expectations. We can see again, over the next year, earnings really aren't projected to grow, but after that, it's expected to be around $29.20 per share in 2026. That's pretty much exactly what ticker data is telling us as well. But to put that in perspective, that's not too far off from where they were in 2023. So really, it's just going to be putting them slightly above those 2023 numbers. So 2024 lower, 2025 again on the lower end. 2026, earnings are expected to get back to a healthy growing rate. So let's just go with that EPS growth rate projection on average. We'll assume no multiple expansion at about 20, and you can see that 2030 annual return would be a total return of about 71%. But again, that doesn't include dividends. That'd be a compounded return of about 9.4% during that time period. If we're a little bit more conservative with our projections, we'll lower this to around 8 and say there's some multiple contraction. All of a sudden, by 2030, total return of around 34%, compounded return of 5%. Now, perhaps the best way to look at this company, though, is through the lens of a reverse discounted cash flow analysis. How much free cash flow growth is currently priced into this stock? Well, we can answer that question. Right now, if we assumed 0% free cash flow growth, the company would be worth about $231 per share. If we bump this up to 5, we get to $358. If we bump it up to 10, all of a sudden we get quite a bit above the current share price. Bring it back down to around 8, we start getting closer, and around 7.5%. That's when we get a reverse DCF price per share that nearly matches the current price. So this is the key number right here. This is how much free cash flow growth the market is currently pricing into Lockheed Martin. If they grow free cash flow at a faster rate than this, it's simple. The stock is undervalued. If it's slower, then the stock is overvalued. And from what we saw from management guidance, they're telling us that free cash flow should be in the range of about 6.6 to 6.8 billion, which would actually be quite a bit higher than what we projected over the next year and in 2026 based on what the market is currently pricing into this stock. So Lockheed Martin actually does look pretty interesting at these current prices. But there you go, those are two dividend stocks currently trading at a 52-week low. Let me know what you think of these companies in the comments down below, and like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.